The housing recession is over, according to chief economist for NAR, Lawrence Young. It's always hard to predict the end of that recession, but we're going to weigh why that may be the case and why it may not be the case. But before we jump into that, make sure you hit subscribe below to stay on top of all of the latest Huntsville, Alabama real estate news. One of the evidences that support this end of the recession for the housing market is that the median sales price for homes across the US were at the second highest level that they've ever been in the month of June. That's pointing towards continued price appreciation, even in the face of higher interest rates that we've seen all summer long. And so if we do have a pause with the Fed in terms of interest rates and even see interest rates drop at any, we may start to see accelerated price appreciation once again. Another piece of evidence that's supporting to this end of the housing recession is that NAR's pending home index actually rose in June to 0.3%. So basically what this index means is it's not closed homes, but it's homes that are under contract and about to close over the next 30, 60 plus days. So that number is rising, pointing towards increased sales, which also may lead to increased prices over the next couple of months. Not only is the pending home sales index up, but multiple offers are actually up as well, not only here in the Huntsville market, but across the US. Now, it's not where it was in 2020 or 21, but it is really amazing that we're seeing multiple offers again when we're at the peak in terms of interest rates over the summer timeframe. And so if we're seeing multiple offers at these interest rates, and interest rates possibly and probably have even peaked, as interest rates start to come down even in 6 months or 2 years, you're likely to see that increase in multiple offers. And why is that? Because we simply don't have enough supply. We have this pent-up demand waiting on the sidelines, where we've really had this 6 million home deficit grow from the last Great Recession of 2008, where we just built fewer homes and we continue to have family formations, resulting in that 6 million home deficit. So it took well over a decade for us to get to that point. It's going to take at least a decade or longer for us to build our way out of that. And so with that, with interest rates being at the peak that they are, multiple offers coming back, that's a big sign that we've potentially hit the bottom in terms of the housing recession. Multiple offers are returning to the marketplace just as interest rates may be starting to peak. The CPI data came in at 3% this June versus 9.1% last June of 2022. So the Fed is making significant dents into inflation. They're close to that target number of 2%. They did recently raise their overnight rates of another 1/4 point, but they hinted that this might be the last time that they raise rates, or there may only be one additional rate hike, and they may just kind of sit here for a while and let inflation do its thing and start to continue to cool off, because that 3% number is a 12-month rolling data. And so it's going to take a little bit of time for it to continue to get down to that 2% level. And so with that, there's been all this fear and uncertainty baked into the 30-year mortgage market, because it's not tied directly to the Fed overnight rate. It's really more tied to the 10-year Treasury, and it's typically, a certain percentage point above that 10-year Treasury. And at this point, we actually, if you look at historical numbers, we have over 1% of kind of what I'm considering fear and uncertainty baked into our 30-year mortgage rate. So we typically have basically our 30-year mortgage rate here with the 10-year Treasury. Now it's up here at over an additional 1%. And so as the market sees that, the Fed may stop raising rates and they're actually going to pause and at some point lower rates once again, it's not going to potentially take us long from going to a 7% rate to potentially 5.5% rate, because that 1% is baked in. And then if we just have 1 or 2 price cuts by the Fed, we could potentially be at that 5.5% rate once again. And why is that so key? Well, we're already at a multiple offer situation. The last time we were at 5.5% rates, we had significant number of multiple offers, and we had a lot of homes going above list price and selling very quickly. And so as we hit that 5.5% level again, we may get into another inflationary environment. Another stat that points towards this end of the housing recession is that the builder confidence level is continuing to rise each and every month. It's actually risen for the last 7 consecutive months, and it's at a level of 56 right now. Builders are scrambling to hire right now to be able to increase that output, increase the inventory. And here locally, I want to tip my hat off to local builders. They're doing a great job of creating affordable housing for our local Huntsville market. Nationwide sales were down 30% in 2022, and they've been down 10% year to date in 2023. But the July numbers so far look like they're going to diverge from that 2023 decline. For our real estate company alone, we saw a 40% increase in both sales and new listings in July. So it looks like we may have hit that bottom in terms of number of homes sold, and then also additional inventory peaking off of that decline and coming back up for the local Huntsville market. Now, we've really focused on the recession for the residential real estate housing space, but one thing that could affect the rebound for residential real estate housing is its cousin, commercial real estate. So commercial real estate is actually just now starting to go into the recession, and is likely to be a long, drawn out recession. It could be several years. And the reason for that is the interest rates on commercial loans operate different than they do in residential. They typically operate on 5 and 7 year ARMs, and a lot of those 5 and 7 year ARMs are set to renew over 2023, 2024, and 2025. And so the challenge is with COVID and so many people not working in office buildings or not needing as much office space as they once did, there's just simply too much office space out there in the marketplace right now. And so values have declined, interest rates are increasing, and so cash flow is not only diminishing, but it's disappearing and basically going negative for a lot of these investors in commercial products and even apartment complexes. So a lot of these investors are going to be in trouble, underwater, and that's going to spill over into the banks. And if these local banks have to tighten up their lending standards for borrowers, that could spill over into the residential sector in terms of affordability and offering first-time home buyers and some of these first-time home buyer type programs for buyers to get into their first homes and just be able to buy in this market. So here's what I think prices are going to do in the residential sector in terms of the remainder of 2023 and going into 2024. And there's some great research out there by Alto's Research predicting what prices are going to do based on certain interest rate levels. And I do agree with them. It is going to depend on what interest rates do. Personally, I think interest rates have likely peaked around the 7% level. However, if the Fed continues raising rates and there's increased fear and uncertainty in the marketplace and we hit that 8% level, then you could see prices stay flat and even decline in this market because 8% is really going to be another key level. We saw that at 6 and even 7% interest rates, and it took buyers some time for them to get accustomed to those levels, and you start to see prices decline in some areas of the country. I think you'll see that again if interest rates hit the 8% level. Now, I don't think we'll see that 8% level. I think we're going to probably stay here at 7%. I think the Fed is going to pause their rate hikes for some time being, and I don't think we're going to see anything north of 7%. I actually think that 7% could go down into the mid 6s and even down to 6% level if we take that fear and uncertainty out of the interest rates. Because again, if you look at that 10-year treasury rate, we still have over 1% extra baked into our 30-year fixed mortgage rates. And so it would not take much to get those 30-year rates back down. And so if we see rates stay around 7% in the high 6s, I think we'll continue to stay relatively flat. I think home prices will stay relatively flat to kind of normal appreciation levels, about 5%. Now, I think where things get exciting or really even scary if you're a buyer is if interest rates get back down to the mid-5 levels, because last time we were at the mid-5 levels with the lack of supply and all the demand that's in the marketplace, we continue to see a buyer frenzy where homes were getting bid up, multiple offer situations, and homes were selling very quickly. And so I do think we'll see that once again at 5.5%. And the question is, does the Fed realize that data, and are they going to try to steer us away from those 5.5% interest rates? But if we do hit, or when we do hit 5.5% interest rates, which I do think could be in the next 12 to 18 or maybe even 24 months, I would bank probably closer to 12 to 18 months. I think we'll see double-digit appreciation once again, not only here in the Huntsville market, but really across the US.